Thank you, everybody. It's a great pleasure being here today. We thank our friends in online mode, and today we have the opportunity to have with us our Nancy Deng from Hanoi Office, and welcome to Shanghai, Nancy. It's a pleasure. We will have a webinar on the certificate of origin in Vietnam, how to get it, and as well after we will have Mr. Tommaso Colli, General Manager of PFC Advisory, which will give us more information about the tax system in Vietnam. Without any other words, I will give the stage to our Nancy and to the presentation. Please, Nancy, welcome.
Good afternoon. Thank you for being here for the presentation regarding the certificate of origin in Vietnam and what you can do to get it. In this presentation, I would like to focus about the general introduction about the certificate of origin, what it is, why it is important, the requirement for you to get the certificate of origin, and the administrative procedure to get it. But first, why would you like to move in Vietnam? First of all, compared to other countries in the region, we have cheaper costs to produce. This includes both material costs and labor costs. Second, we have fast-growing industrial park and upgrade infrastructure. For example, in the north of Vietnam, we have the direct highway and railway to China, to the border with China. And the third, we have the free trade agreement with our neighbor like ASEAN and China, and also very far country. Next year, we will have the EV-FTA come up. And the moment that EV-FTA is active, it will eliminate more than 85% of taxes of Vietnam products to the EU. So that is why I would like to talk about the certificate of origin today, because it is an important document for you to enjoy the tax incentive with our partner. Also, even if you don't get tax incentive from the country, when you export the product, then in your dossier, the certificate of origin is required. The certificate of origin will be given by the Ministry of Industry and Trade, maybe directly or depends on the province. They can authorize the Vietnam Chamber of Commerce and Industry, Export and Import Management Office, and the Management Board of Industrial Loan. And here I have a few authorities that will give the certificate of origin in Hanoi, Ho Chi Minh, and Da Nang, which is the three big cities of Vietnam. So, how can you obtain the certificate of origin? First, please note that in this presentation, I will only focus about the Vietnam law and regulation. In case you export to a country with the tax incentive or with a free trade agreement, then you also need to refer to the free trade agreement because the number of Vietnamese material may be different or some procedure may be slightly different. But generally, the certificate of origin will be given to wholly produced goods in Vietnam or partially produced goods in Vietnam and meet the requirement. The requirement include, first of all, must have the last fundamental stage in Vietnam. Second of all, it meets one or both of the criteria, which are the LBC, refer to the percentage of Vietnamese material, or the CPC, refer to the change in HS code. We will go through it one by one. First, for the wholly produced and obtained goods in Vietnam. The Vietnam law and regulation have a list of the goods that are considered as wholly obtained. And if your good is in the list, then okay, no more requirement needed. You're good enough to have the certificate of origin. However, the list only include this one. I'm summarizing plant and product from the plant or animal, or mineral or good from sea fishing, for example. And for most of industrial product, because you export, because you import the material, or maybe you buy the material in Vietnam, however the material is already a foreign material, then you cannot be in this list, and you have to move to the second one. The goods that are not wholly produced and obtained in Vietnam. And for this good, the first requirement that you need to meet is the last fundamental chain that obtained in Vietnam. So what are the fundamental chain? It refers to the transformation from the material into the products. And if the transformation is enough, which means there is a Vietnamese character inside your products, and therefore good enough for certificate of origin. So in the mind of authority, in order to evaluate whether the transformation is enough, they will ask, in your factory, will you have any machinery? Will you have an assembly line? A complicated one, not just a line, easy, simple, not just a table. And will you have to train worker? And if you answer these three questions properly, then okay, the product is complicated enough, and you pass this test. They also list some of the activity that doesn't count when they issue the CO, which include label the products, clean it, maybe dry it, or just simple packaging. Like you make the product somewhere else, bring to Vietnam, put to a bag, and release to market. Then it doesn't count. And this is a must-have. After your product is passed this test, it will be the second test, which are the list of product-specific rules. I have some example of the list, as you can see. The list will have 3 columns: the HS code, the description, and the rule for the description. Normally, the rule is LVC, which refer to the minimum of Vietnamese material in the products compared to the value of whole products, and CTC, which are the change in tariff classification. We will go through the LVC first. The LVC, simply explaining, is that it refers to the percentage of Vietnamese material compared to the value of the completed products. So it's an added value. For example, if you choose the LVC method, they will examine all the material that you make that final products, and you say, okay, this is the value of Vietnamese material, this is the value you sell the products, and how much it is. If it reach a certain percentage, normally it's 30%, but it can vary. Let's say it's 30%. If it reach 30%, then okay, you have 30% of Vietnamese material value. Then the product is Vietnamese enough to get the certificate of origin. However, practically speaking, for some of our clients, they already have their favorite supplier in China, or they already have the foreign imported material, even though they buy in Vietnam. So the 30% they may not reach it. That's why they choose the second method, which is the change in tariff classification. As you may know, every product, every material has the HS code. And in Vietnam laws and regulations, they only calculated the first 6 number of HS code. And if the HS code of material and the product, the final products, is different enough, which means a transformation has happened in Vietnam, and therefore they are good for Vietnam products. To be more specific, for example, this is 6 number of the products, the final products, 1, 2, 3, 4, 5, 6. And if the product is using CTHS, this is regulated in the list of product specific rule. You cannot choose. So if the product is this, then the material must be 1, 2, 3, 4, 5, 7, and it's good for CTHS. And you can get the Vietnam origin. For other, which is CTH, they calculated the first 4 number, and if it's different, the combination is different, then it's the Vietnam, then it's good enough for Vietnam certificate of origin. And the hardest one, they calculate only the first 2. And if the products you produce is in this criteria, which means that you have to import very raw material. They cannot be in the same chapter of the final products. You have to import very raw material to make the final products good enough for certificate of origin. To make it easier for you, here's an example. For example, a company intends to apply for certificate of origin for their vending machine. This is the HS code of the vending machine. In the list of product specific rules, the vending machine applies CTHS, which means the combination of this 6 number and the 6 number of imported product from Germany, China, Cambodia must be different. So they calculate this one compared to this, different. So the product is Vietnamese enough because the transformation from material to final product has happened. And if they choose CTHS, then they get CO Vietnam. If they choose LBC, they will calculate this one, the Vietnamese material, compared to the value of the whole price of the machine. And if you see, it's 30% according to the list. Then okay, it has enough Vietnamese material in this one, and it's good enough for the vending machine to get CO Vietnam. But of course, please remember that the first and foremost condition is that they have to, even though they import material, they need to assemble this machine in Vietnam complicatedly. They need to hire someone, they spend time to train the employee, they need to invest in the factory and modern technology. If they bring, for example, the whole thing from Thailand to Vietnam, and then they put the colorful color in the vending machine, then it's not good enough for certificate of origin. And once that your product is good enough for certificate of origin, how can you get it? This is the administration procedure. First, you need to register for company profile. For company profile, it only applies for the first time application. If you already applied for CO before, then this step can be removed. You don't need to register again with the issuing authority. Second, you need to prepare the CO dossier. The CO dossier is different depending on which product you export, how regularly you export it, like every few months, or you just export that one time, which country you export the products to. And also, in all of CO dossier, it will be an explanation of how the product is made in Vietnam. And it is an important document because the authority will look at it and see that you make this 5 steps in Vietnam and it's complicated. Good. You bring modern technology to Vietnam. You use our high qualified employee. So okay, it's good enough for Vietnam certificate of origin. Next, you submit the dossier. After from 7 to 10 days of preparation, the CO dossier is ready and you submit it. Please note that the dossier, most of them is in Vietnamese, or at least bilingual. You cannot submit English document. For the dossier, you submit it online. However, depends on the requirement of the issuing authority. They might ask you to bring the original one to their office later. After the submit, the 4th step is verification. This step doesn't apply to all factoring. If the dossier is trustworthy enough, if you are clear enough in the dossier, maybe you don't need to verify. They will issue you the result already. But for the rest, they will send a specialist to your factory. The task of the specialist will be like verify all the information. Are you imported the material that you say? The other material, are you buy it in Vietnam or not? Do you actually have the assembly line in the factory or you just say so? And after the verification, they will issue the result. If the result may be negative, if it is so, they will have to say why they deny the certificate of origin, how can you fix the certificate of origin to reapply. And if the result is positive, then they will issue the certificate of origin. The whole process of administrative procedure is around 3 to 7 days from the moment you submit the dossier. It will be 7 days if they need the verification step, but normally after 3 days, you will get the certificate of origin. Okay. And next, may I introduce Mr. Tommaso Colli for you.
Thank you.
Thank you. Okay, I will follow up on what my colleague presented with a short presentation of Vietnam tax system. I will start briefly introducing PHC. Okay, wrong. PHC is a company part of DP Group. My colleague that presented earlier is part of DP Legal Counsel, which is the law firm pertaining to DP Group. While PHC is the tax accounting and financial advisory firm pertaining to the group. What we strive for can be presented, I'd say, in few main points. We have specific professionals that are able to provide the best and fastest service when it comes to tax, financial, and accounting advisory. Our main point of view is to try and be as close as possible to our clients in order to provide very specific and tailored solution to potential issues or actual issues if they already happened, but potentially to anticipate which are the issues or anticipate potential opportunities. We work in 4 different areas. The outsourcing of the bookkeeping, the accounting advisory, the financial supervision or internal audit, any M&A and extraordinary activity which can be related to acquisition of a specific asset, acquisition of a company, sale of equity, sale of a specific asset, in company restructuring, relocations, and so on and so forth. And also business consulting, so any activity that is targeting a specific topic, which can be personal tax, corporate tax, tax optimization, and so on and so forth. Coming to today's topic is Vietnam tax system. I would like to say a few words before starting. Vietnam tax system, in this presentation I make many comparisons with the China tax system for 2 reasons. Mainly because many of the companies now beginning to or already working in Vietnam most probably have already experience of China, so it can be easier to understand the Vietnam tax system with the comparison with China, and also because in my opinion of tax advisor, there are many similarities, really many similarities, and you will notice this. Okay, first of all, personal income tax. You can see that it is structured in an extremely similar way, to the point that some numbers are almost identical, and it's structured in progressive rates. For Vietnam going from 5 to 35%, and for China going from 3 to 45%. In terms of rates, it's slightly better when it comes to Vietnam, but please consider that if we put the numbers from Vietnamese dong into RMB or yuan, we are talking about 0 to 18,000 RMB with 5%. And in China, 0 to 36,000 with 3%. So it's quite more beneficial, although this is related to the most recent tax update that happened this year in 2019. And when we talk above 960 million, we are talking 283,000 RMB. And if we go to the similar bracket in China, we're talking almost 3 times as much. So the benefits and also in China there is additional quick deduction. So overall, I'd say in terms of personal income tax, the rates in Vietnam are not so beneficial. The good thing though is that the highest rate is 35%. So below that, much more beneficial in China. Above that, obviously there's no 45% rate. So if you earn anything more than this, you only apply 35. But if you're lucky enough to earn 4, 5, 6, 10 millions, then it's definitely beneficial. Otherwise, if you're in this region, not so beneficial compared to China.
For the employee and blue collar point of view, is 10 or 15% rates, so it's better than China.
It depends how much are the...
Considering the $500 salary average.
And then if you consider that, you're in this region, so it's actually not beneficial, it's actually worse. I'd say not for blue collar, maybe for junior white collars, it could be better. But overall, I'd say the biggest benefits are for white collars with a sensitive enough package. When it comes to the recognition of tax residency, it works similarly to China when we consider the 183 days to be spent in Vietnam in a solar year, but then there are also other two elements, which are permanent residency in Vietnam, which makes sense, or also leasing a residence for 90 days or more in a tax year. And generally speaking, this works again exactly like in China, although in Vietnam there's no tax break, so you have to declare all your worldwide income if you are a Vietnamese resident. If you're not resident, you only declare and pay taxes on the Vietnamese sourced income. There's lots and lots of deductions, again very similarly to China. There are, I only listed the main ones because frankly speaking there's like dozens of different ones, even related to people that were in war, people that have won awards, specific awards, and many. I just listed some which are related, I'd say, to very standard ones, so phone, meal allowance, and per diem, something that we are all familiar with, but also we can see that Vietnam still considers some elements such as working in specific environments that can be toxic, dangerous, and working in areas that are more remote, so less economically developed, which is something that pertains more to West China nowadays, rather than the whole country. And then there are specific ones for expatriates, which I'd say are less beneficial than the ones, less extensive than the ones provided in China, and are quite standard, which are like relocating expenses, school for the children, the one-trip ticket, which is very common, and some other expenses. Corporate income tax is generally speaking lower than in China, and there's a lot of tax preferential rates, again similarly to China, but there's many different options to obtain this, to be eligible to obtain these preferential rates, which are mostly being engaged in high-tech activities or specifically targeted preferential activities. And there's been a recent news that I read actually this week, which is that there might be tax incentives for small and medium enterprises. This used to be there around 10 years ago, then they were removed, and now they might be, but it's just so far a rumor that there is a discussion among the government to reinstate those. And when it comes to domestic dividends, there's no taxation. Capital gains are taxed like any other gain. Losses can be brought forward for 5 years, exactly the same as China. Dividends are to a foreign shareholder are taxed at 5%, interest 5%, royalties 10%, which is similar. These are better than in China. This is exactly the same. Technical fees. On technical fees, there is a withholding tax, which is split as it should be in income tax and VAT. It's a maximum of 10%, so this is actually better than in China, where it is a maximum of 16%. Yeah, that's about it when it comes to corporate income tax. In terms of VAT, there are 3 rates. Standard rate is 10, which is very low. And 0% applies to exports, so this is actually extremely good because there's no, tax inefficiency when it comes to export. There's no dealing with export VAT refund, which is quite annoying, let me say, procedure that we have to go through in China. And 5% applies to various products which are considered mostly essential, products and services. There seems to be an issue here with the slide, I'm sorry about that. I'll try to go back and forth, still the issue, sorry. There's a special sales tax which is similar to the excise that are applied in many different countries in the world, and it's related to goods and services which are considered luxurious, non-essential, and you can see many different things that most of us or everybody enjoys: cigarettes, cars, clubs, karaoke, and so on and so forth. And this tax can be as high as 75%. So bear in mind that with these specific goods, there is a taxation that is much higher and much less advantageous than the one of some other goods. This part, I'm sorry, it's partially cut out, but it's related to the social contributions. Similar to many other countries, there are social contributions which are the social insurance, health insurance, and unemployment insurance. The first one is the most conspicuous one, which is 25.5% divided mostly onto the employer rather than the employee. The health insurance is 4.5%, 3%, and 1% divided employer and employee. And unemployment one only applies to locals, because obviously a foreigner once he or she doesn't have the chance anymore to have a job unless he's linked to another visa, he has to leave the country. It's actually also the lowest one in terms of percentage. And when it comes to health insurance as well as social insurance, the amount to be paid for a foreigner is actually lower. So we could say that given the same profile, given the same salary package, it's more advantageous to hire a foreigner than a local. But then again, it depends on many factors, but at least on a pure contribution perspective, that is the case. Last but not least, when it comes to the tax compliance in general, the tax year is the fiscal year, which typically is the solar year. There can be some changes on that, meaning that some companies could ask the tax authorities to change the fiscal year into a different one, which is not the solar year, so January to December, but generally speaking it's like that. CAT is declared on annual basis, which is the same case of many jurisdictions around the world, and although there is something that goes close to what's in China, but it's not exactly the same, which are quarterly declarations. In China they are mandatory, so every quarter you have to declare and pay CAT. In Vietnam it's different. There is a provisional declaration, meaning that you estimate, you can already pay, but you can also just estimate, declare, and end up paying all at the end of the year. But there is one important element to consider, which is that if you extremely underestimate the taxes, so just say quarter 1, 2, 3, I estimate 1,000 dong of CAT and end up paying 10 million at the end of the year, you might face some penalties because of that. And this is just a way for the tax authorities to control the inflow and outflow of funds related to the corporate income tax, for them of course. When it comes to personal income tax, it's withheld by the employer as it is in any jurisdiction, and there is an annual declaration which wraps up all the payments done on a monthly basis, and VAT is declared and paid on a monthly basis. This is all for my part. Thank you very much for listening. Any questions?